Good morning, everyone. I hope you're all well. Thanks for joining our webinar today on tax tips for UK landlords. I'm Graham Smith, and I'll be presenting today as well as my colleague Peter Magorka. We are both global tax advisors at Sale, and we will be taking you through the tax tip for UK landlords and how we can help you. Before we get started, just a quick disclaimer that this is generic tax advice, which needs to be tailored to meet your specific situation and desired outcome. We advise seeking tax advice from a tax advisor to ensure that the legislation and laws are correctly applied to meet your specific needs. First of all, some general landlord tips: that it's always advisable to keep accurate records. This ensures compliance with HMRC, reduces the risk of issues down the line, and enables you to keep track of your business performance, whether you're operating at a profit or a loss, or if there's any income leakage. And also, it is important to know your reasons for investing, whether you are looking for extra income to supplement your living expenses, or you're thinking long-term in terms of estate planning and inheritance tax. And then it's also important to compare whether you're operating in your personal capacity or as a limited company. We'll delve into this specifically as we go on in the presentation, as there are different rates that apply and different allowances that apply to personal as well as to companies. And there are different taxes that you will come across during your time in the landlord business. The first one is stamp duty land tax. There are different rates for residential and non-residential properties. First-time buyers, if you already own a property, as well as if you're a non-UK resident. And the value or the amount of tax changes depending on the value of the property. It starts at 5% and it can go all the way up to 15%. If you're operating as in your personal capacity, you'll pay income tax on the profits from your rental business, and this will be at your normal personal income tax bands from 20 to 45%, and you'll also be entitled to your personal allowance that would reduce your tax. If you're operating in a limited company, you'll pay corporations tax, either 19 to 25%, depending on your overall profits. Also, if you're operating as a limited company, there'll be dividends tax on any amounts that you take out of the business. This is also from within the normal dividends tax rate bands from 8.75% up to 39.35%. And you'll be entitled to your tax-free allowance of £500 of dividends per year. And is capital gains tax on the growth of the property. If it is an individual, it'll be 10 or 20%, depending on it, and the rate of tax, 18 to 24% on residential property, and you will get a tax-free allowance of £3,000 in your personal capacity. If you're operating as a limited company, there's no capital gains tax, but you'll be liable to corporations tax on any gains. This will also be discussed in more detail later. Another important key aspect to always consider with capital gains is if you sell any properties, you have 60 business days to submit a CGT tax return to the HMRC. This needs to be complied with, or as they will issue penalties on late submission. If you're a non-resident, this needs to be done within 30 days. And lastly, annual tax on enveloped dwellings. This is an annual tax paid by companies if the company owns properties, or if it's owned by a partnership, but that partnership is owned by a company, that is then payable, and it's payable on if the properties owned are greater than £500,000, and it excludes it's for residential property, so it excludes hotels, guest houses, boarding schools, hospitals, and so on, those types of properties. Now, important thing to consider is whether you're doing the cash basis or accrual basis. This only applies to if you're operating in your personal capacity, as if you're operating in a limited company, the accrual basis always applies. And simply the cash versus accrual basis is whether it's received or paid compared to receivable and payable. So that determines when the taxing event takes place. Accrual basis as a personal, if you're operating in a personal capacity, you can either opt into it by election, or if your gross property income is greater than £150,000 for the year. This is important as certain expenses and allowances are allowed differently depending on the basis that you decide to operate under. Now, there are certain release and allowances that apply mainly to your primary residence. There are two that apply to income and two that apply to capital. The first one is rent a room relief. If you rent out a room that is in your only or main residence, the first £7,500 of income can be discarded as profit, but it will not be taxed. If it is above this, then it will be taxed. This way, you do not affect your CGT on your sale, as you still keep the full value of your property. The next one is a property allowance. So if you're renting out a small portion of your house or for a small amount of time, the first £1,000 of income is tax-free or doesn't have to be disclosed. But if your expenses are greater than your income, you can elect to use the expenses, and that way you can create a loss which can be carried forward. Now, if we look at the capital side, the first option is, or first available allowance to you or relief is private residence relief. So this applies on the sale of your main residence. And if you have a spouse, you can only have one main residence between the two of you. But essentially, your capital gain is sometimes diminished, or the relief that you get for having a primary residence, the exemption you get, will be diminished if you let out part of your property. But this allows you to still claim it if your period of dependent on your period of occupation. So it will be apportioned based off that. And then lettings relief is applies on the same principle, but it works on lettings relief. It's the amount that you get on your primary residence relief, but it's the lower of the gain attributable to the letting, the primary residence relief, or £40,000. If it's below that amount, there will be no CGT payable on your primary residence. Next, it's important to look at the nature of your expenses, whether it's income or capital. Now, a lot of these expenses and the details behind them will be discussed later by Kutso, especially on the capital side and your allowances, but it's always important to consider whether it's income or whether it's income expense or capital expense. So now your expenses should always be wholly and exclusively for the business of letting. However, certain expenses can be apportioned based on the private percentage or the business percentage that would be allowed. However, they must still be in line with your letting business. So you cannot just claim a general expense and say a portion of it. It must have a real business element. So some of these normal income expenses are things such as repairs, agent fees, commissions, water, electricity, and so on. And then also it depends, certain expenses on how they're allowed. It depends on if you're operating in your personal capacity or as a limited company. For example, interest on your mortgage is only allowed a 20% tax reducer in your personal capacity. So this is much less tax advantageous compared to in a limited company where it's allowed in full. So once again, you'd have to weigh up what option is more beneficial for you when you consider personal allowances and other capital allowances that are available in each, whether it's personal capacity or in a limited company. And then another option is also replacement domestic items relief. So this applies to residential properties only, and you get an allowance on the cost of replacing domestic items such as furniture and appliances. And so you're limited to the cost of something that would be seen as substantially the same. So if you improve it, you only allow the cost of what would have been the same as the asset you are replacing. So that is important just to bear in mind, and that applies for both limited companies and personal, and it's operating in a personal capacity. Another important thing is rental losses. So your rental businesses, if you have multiple properties, are seen as one single trade. This doesn't include foreign properties, which we won't discuss in much detail, just referring to UK landlords, but those are also seen as a separate trade, but all UK property is one trade. Now your loss cannot be carried back. But the loss cannot be carried back, can only be carried forward and offset against future years' rental profits. And you cannot create a loss in nominal lease. The nominal lease is a lease that is below market value. In that sense, you can only claim expenses up to income, and then that is where it stops and no loss can be created. Another important thing is pension contributions. This is a great way if you're operating as a limited company to reduce the tax, because it's a pre-tax deduction that can be made directly from the company. So you're not subject to the normal limits on pension contributions of your annual income or £60,000. You can make a higher amount if it is deemed fair and reasonable. As I said, it's a pre-tax deduction, so it's a great way of reducing corporate tax. And then in your personal capacity, you are benefiting yourself in the long run because you'll have a bigger pension to draw from in the future. The last thing that I'll be discussing is furnished holiday lettings. So many of you might know that this has been proposed in the latest budget speech, and that it will be ending on the 6th of April 2025. So this is very important for individuals operating a furnished holidays letting business, as you'll lose several of the tax benefits that come with a furnished holidays letting, such as your interest will now be limited to the 20% tax reducer. It will not be allowed in full. You'll lose business asset disposal relief, and your pension contributions will no longer, or income from a furnished holiday letting will no longer be seen as relevant earnings. So your pension contributions will also be limited based off figures provided previously. I'll now hand over to Kutsu, who will go into more detail about certain areas and allowances that apply in those aspects. Thank you.
Thank you, Graham. Just as a reminder for everyone who's joined us today, we will unfortunately not be having a Q&A today. So if you do have any questions or anything that you just want to clarify that comes from the webinar, please feel free to either reach out to us directly or book a free 15-minute consultation. Now, the more you grow in your landlord journey, the harder it can get to either receive rental profits, because it might be taking you into a different tax rate band, purchase more property, sell your property, or maybe plan for inheritance for those who need it. A good way to save tax while extracting things such as rental income is to transition your landlord business into a limited company. As mentioned earlier by Graham, companies are subject to a corporation tax amount, minimum of 19% and a maximum of 25%. This can greatly differ from the individual tax rate higher of 45% and create some real tax saving on the tax on your rental income. Now, given that companies are not subject to capital gains tax on the sale of property, this can offer a great way to utilize any retained funds from the sale of property within a limited company to maybe purchase more property and grow your business. Other great benefits is extracting rental profits by way of dividends, which allows you a tax-free allowance of £500, as mentioned earlier, in addition to your personal allowance of £570. Now, as a limited company, there is also what we call the indexation allowance, which is given to those that have owned property before 31 December 2017. Now, the indexation allowance is a tax relief provided to adjust the capital gains on an asset for inflation. What this does is that it ensures that only the real gain and not any inflationary increase in value is subject to tax. Another great tax tips for those looking to make additions to the properties, maybe increase your profits, or maybe just adopt your building for a more modern look, is what we refer to as the structure and building. Now, this applies to expenditure on the construction, renovation, improvement, and conversion of a qualifying non-residential property. So this is stuff like office spaces or a business using commercial property in trade. This particular allowance is a great way to reduce your total profits earned from the property, as it allows the amount to be offset from income. Now, the amount is limited to the net direct cost related to the physical constructing of the asset. So it has to be directly linked to whatever building or addition that you made to the property itself. Now, another way to reduce your capital gains tax, whether you're looking to either close down your property, wind down, or just to sell an asset within your company, is what we refer to as the business asset disposal relief. This can be quite beneficial if it applies to you. Now, how it works is that it substitutes the general CGT rate with a flat rate of 10%. in place of any other usual capital gains tax that you might have. Now, this relief is available on the whole gain arising on the disposal either of a share in a company that meets, again, the conditions, or on the sale of the property itself. Now, some of the properties that qualify is the furnished holiday lettings, as mentioned earlier by Graham. Because this is being phased out, it is important to consider whether this can be a good option for you to move on from this type of business. Other types of businesses that cannot qualify for this business asset disposal relief is used in a business subject to the qualifying criteria for a specific period. Property development or property management companies can usually go for this. Now, if your business is involved in more than one service, so a combination of what we've mentioned prior, it might be worth considering this relief. However, any non-qualifying activities must be less than 20% of the total company for you to still be able to claim the business asset relief. Now, due to the level of complexity of the specific relief, it is important that you reach out to a tax professional to sort of assess your business, assess what you're looking to sell, and assess on whether this would be a good way to reduce your overall capital gains payable. Another way to minimize income tax payable or capital gains payable is to transfer your assets. Now, it sounds a bit mundane, but when you're transferring your property to your spouse, either a husband, a wife, or a civil partner, there is no capital gains on the actual transfer itself. And what this transfer of the assets can do is it can either minimize the amount of rental profit that you are earning, and that now it becomes, divided into two. Or alternatively, in the event that you dispose of that asset, you can increase your capital gains tax-free allowance from 3,000 for yourself only to 6,000 for both yourself and your spouse. Now, where your spouse has unrelated income, which does not fully absorb their personal annual allowance, this transfer can be a good way to split the profits and use up your spouse's personal allowance in order to sort of decrease the tax payable. A word of caution, any transfer that is made specifically for the purposes of avoiding tax may flag anti-avoidance provisions. So it is, again, advisable, contact someone and see if the transfer, one, will be suitable for your type of business and your type of asset, and two, if it will yield any tax saving opportunity. Now, for all of the property investors that are non-UK residents or offshore investors, there's what we call a non-resident landlord scheme, which can sneak in unwanted taxes. Now, the non-resident landlord scheme is a withholding tax regime for rental income, which is payable to non-residents. How it works is usually letting agents or tenants are required to withhold 20% or withhold tax up to 20% on the net rental income for the non-resident landlords on a quarterly basis, unless the HMRC specifically gives you permission to receive the gross. Now, the permission route requires a whole different application, so you can prove a few things before they can let you escape this. Now, additional taxes that would apply in addition to this would be your stamp land duty tax, which would be payable on the purchase of your property. There can be certain surcharges that are payable depending on whether the property is a second purchase or if it's being purchased, for instance, through a limited company. Now, for residential properties by non-resident individuals, if the property value exceeds 500,000, then there is a flat rate of 15% for the stamp land duty tax, unless specific reliefs are available. These reliefs, one of these reliefs is what we refer to as a multiple dwellings relief, which applies when you're purchasing more than one dwelling in a single or linked transaction. So what then happens is the SDLT tax is calculated based on the average value of the dwellings as opposed to each dwelling individually. Now, other instances where being a non-resident landlord in your personal capacity as opposed to being a non-resident landlord in the capacity of a company is, for example, the 15% higher rate of the SDLT, which is the stamp duty land tax, and the charge of the annual tax for enveloped dwellings can apply to the acquisition of non-resident companies purchasing property, but it does not apply where the property's been acquired by a non-resident individual, for instance. Other additional reliefs for these types of charges can apply where, for instance, the property will be exclusively used for the purpose of a property rental business, and it will not be intended to be occupied by non-qualifying individuals. HMRC lists non-qualifying individuals as people that you are not sufficiently connected to, so family members or people that would not ordinarily have an interest in the property, so your children and your spouse. Now, inheritance is often the cross that bridge when we get to a topic, but for landlords, who have high value assets, that is, it is important to plan ahead. For instance, the structured nature of a company can allow a smoother transfer of either the property or the share equivalent to surviving beneficiaries. Since the assets are owned by the company and not by the deceased themselves in their individual capacity, there may be room to escape certain taxes that would ordinarily be payable in your personal capacity. Now, for properties owned in your personal capacity, if you choose not to transition to a limited company, transferring your assets or your spouse inheriting your assets will be CGT exempt, and the spouse will pick up the property at the same base cost as you when you purchased it. For any other transfer, just please note that there will be what we call a rebasing of the base cost, which means that they will take the base cost as at the date of death, or the market value of the property at the date of death, and consider that the base cost, quote unquote. A good way to avoid certain taxes that come with inheritance is maybe to gift some of the property during your lifetime, subject to the relevant 7-year or more rule. But also just general tax planning. If you do have a limited company, what happens in the succession plan? You know, who does it go to? Do I choose to give away the property that is within the limited company, or to give away the share value of it? How does the succession plan look if you're an individual, for instance, as opposed to if you own limited company? As can be seen from the multiple tax tips that we've discussed today, tax planning is not a one-size-fits-all approach. And some of these tips may be relevant to some people and maybe not relevant to others. A good way to get started is by conducting what we refer to as a health check. Have a look at your situation, assess where you fall within the tax saving spectrum, assess which of the options and which of the reliefs might be beneficial for your specific situation, and plan properly. Plan to avoid tax leakages and plan to increase your landlord journey or the properties in your landlord journey. Now, how we can help is we can assist with assessing your situation and advising overall on what's the best approach for either increasing your properties or alternatively saving any tax leakage could be. We do offer tax advice throughout multiple tax jurisdictions. So for all those offshore investors who are non-resident landlords, we can assist looking at things like double tax agreements and how they might come into effect in minimizing the tax related to your UK residential properties. If you have any questions, because this webinar was a bit of a mouthful, please feel free to either reach out with your questions directly between myself and Graham. Our details are on the screen now, or you're welcome to book a free 15-minute call with our tax team. In the free 15-minute call, we can discuss everything from what the situation looks like, how we can better save you on taxes, and what the structure can look like going forward. Now, the slides and the recording, I believe, for this webinar will be uploaded and sent to the people that have registered. So the details, our email addresses, as well as the link for you to book will be made available. Right. To everyone that joined, thank you guys so much for taking the time to join us. Please keep a lookout on our social media platforms for any additional tax tips. If you have or would like for us to have a look at your specific situation and how that can change, you're more than welcome to reach out, and our tax team will be readily available to assist. Thank you, guys.
Everyone.